Today, we're going to be reviewing and doing a live, or I like to say a full live deal breakdown, start to finish. There's a real acquisition analysis, and this is what we usually run our clients through in the Continental and here at Acquire Weekly. So, what we'll be walking through is the business profile, 3 years of financials, a full quality of earnings adjustment, the evaluation, the financing stack, and the cash value return, right? Or the cash flow return. The company is Midwest HVAC Services, a 42-person operation, and mechanical services business out of Columbus, Ohio. Currently, they're doing $5.4 million in revenue, 1.41 million in adjusted EBITDA, and their multiplier, or where they're currently priced at, is around 4.25. So that's a 4.25x multiplier. Enterprise value comes in at a whopping, I'd like to say a whopping 6,100,000. But by the end, you'll know exactly how to read a deal like a professional buyer. So let's get into it. I think it'll be pretty easy and pretty smooth. So let's orient ourselves of what you're currently buying, right? So Midwest HVAC has been operating for 15 years, and longevity matters in lower middle market acquisitions. So you're not buying just a startup, you're buying their systems, their employees, their customers, and how long they've been around, right? So you're looking at 42 employees, meaning it becomes a real operating company with management depth, right? It's not some simple two-person operation where the whole business walks out when the owner leaves. You're buying something that's already stable and has been built over the course of 15 years, right? So one of the biggest green flags that this current company currently has is that 38% of revenue is recurring, and they come from maintenance contracts. So before they book a single new deal or a single new job, $1.95 million is already in the books. That's money that's going to keep coming in without you having to book a single job. Now, that's really what buyers pay at a premium cost. So at that premium cost, you're buying that customer concentration and that customer retention. So it also states that their top 10 clients are only 18% of revenue. So compare that to businesses where one client is 40%, which is usually a deal killer or a deal breaker. This one passes right off the bat. So the owner handles sales, which we'll structure around with a seller earnout, and then it's manageable, right? So there's no red flags on that course. Now, here's the 3-year income statement. We always want 3 years minimum. I always require that we receive three years minimum, and you'll see why. So it tells us whether the business is growing, it's becoming stagnant, or it's declining. So this one is clearly growing. Revenue went from 4.21 million in 2022 to 5.14 million in 2024. So that's a 22% increase over 2 years. Healthy or organic growth, right? So it's not just coming because of them scaling, it's actually coming organically. So gross margins is holding steady at around 49%, which is typical for a well-run HVAC company. If margins were shrinking, we'd want to understand why, right? Would that be due to, pricing pressures? Would that be due to, increase in labor costs? Would that be due to increase in material inflation? Because again, you're also buying materials to provide those maintenance contracts. Now, here they're holding, which is a good sign. There's no drop off, and reported EBITDA of around 1.16 million. That's what the seller's tax returns show. But, and huge but reported EBITDA is not what we underwrite to. Owner operated businesses always have personal expenses running through the P&Ls. That's normal and legal. So, our job as a buyer is to normalize them. And that's on the next slide. So the most important slide in any deal analysis is the quality of earnings adjustment. When you look at a seller's financials, what you see and what you should underwrite to are two different numbers. So what's the first one? Owner's compensation. So Dave is paying himself $305,000 a year But if you look at it based off market value, a professional GM costs $150,000. So that's a $155,000 add back, which is real cash flow to a new owner, which they immediately capture off a win. Second, a one-time legal settlement of $48,000. Happened once in 2024, not repeating, so we usually exclude that. Third, two personal trucks running through the business, $32,000. That's an add back. Fourth, owner's life insurance. It's costing the company $18,500. That's a personal benefit. That's an add back. So the total add backs come at $253,500. So reported EBITDA was 1.16 million. Adjusted EBITDA is now 1.41 million. And here's why this matters. At a 4.25 multiple, that $253,500 difference is worth 1.08 million in purchase price. Okay? So that's a big jump. So the quality of earnings is your edge as a sophisticated buyer. Now, let's visualize the growth story, right? How is it growing? Revenue has grown every year. So it started out at 4.21 million, then it moved up to 4.68 million, then 5.14. That's a 22% 2-year increase at a 10.5% CAGR. So for a business in a fragmented, recession-resistant industry, that's excellent. EBITDA has grown even faster. So if you check that, up 75% over the same period. That tells us that the business has been operating with leverage. So revenue grew 22%, EBITDA grew 75%. Margins are expanding, not contracting. So gross margin holding at 49% consistently is your first signal of a well-managed business. When margins don't fluctuate, the owner has purchasing power and cost control. Post QOE, we're at about 27.5% adjusted EBITDA margin. For HVAC services, anything above 20% is strong. So 27.5% tells us that this business has real competitive advantages like those reoccurring contracts. So when you're presenting to a lender or an equity partner, this chart becomes the story of how the business is doing. Now, here's how we arrived at the purchase price. So the formula is simple, right? We look at the adjusted EBITDA times entry multiple equals enterprise value. So what are we doing? 1.414. Well, technically, let me do the entire number. So 1,414,100 times 4.25 equals 6,010,000. Now, why 4.25? Let's talk about it. Multiples in HVAC typically start at around a 3.5. So the floor of a small HVAC company with no recurring revenue is around 3.5x. You're essentially buying a job. The ceiling for one with strong recurring contracts, institutionalized quality systems can reach up to or higher than 5x. So Midwest sits comfortably in the middle. 30% recurring revenue pushes us above the floor. The fact that we don't yet have a professional management layer beyond the owner keeps us from claiming the top of the range, right? We still have the owner in place and he's managing sales. Now, seller originally asked for 4.5x. We came in at around a 4x and then settled at a 4.25x. That negotiation saved us $353,000. So think about that. We saved $353,500 just on negotiations, bringing that multiple slightly down. Now, this is how we're actually paying for the deal. So it's check the charts, check the examples. The capital stack has 3 components. First, buyer equity. So we're coming in at $1.5 million in cash, 20% of the price. The SBA requires a minimum of 10%. So we're all well above. More equity down means a stronger loan application and better terms, FY. Second, SBA 7A, the loan itself will be at 3.81 million, the gold standard for lower middle market acquisitions, which the terms of that SBA 7 loan is going to be a 10-year term at 10.25% rate, prime plus 2.75. Monthly payments are going to be $50,456 or annually $605,472, right? Seller note, we're taking a seller note at 700,000, roughly 11.6% of price. The seller only gets paid if the business performs. That creates alignment. So the SBA requires a seller note on standby for the first 24 months. Seller can't collect principal or interest during that term or that period. This protects the lender's position. So there's 3 layers to it. So there's equity, senior debt, seller paper, and then we minimize your equity check and maximize your return. And the moment of truth. Does the deal pencil? What does that mean? So we start with 1.4 million in adjusted EBITDA, subtract the SBA loan payment, that's 605,472 annually, subtract the seller note, that's $162,372. That leaves us at around $767,844 in total annual debt to service. So we also set aside a CapEx reserve of 2% of revenue. So that's about $102,800 per year. Every physical business needs capital reinvestment, FYI. If you don't do that, it's not smart, trust me. So if you don't budget for it, you'll feel it eventually. So net cash flow to equity is about $543,456 per year. That's about $45,288 per month hitting the buyer's pocket. So cash on cash return is about 36.2%. The buyer put in 1.5 million and gets back approximately, not approximately, but they get back $543,456 in 1 year. The stock market averages about 10%, ladies and gentlemen. So this deal is 3.6x times better than the stock market average. And we come in at around a DSCR of 1.84. The SBA requires that DSCR is at the minimum of 1.25x. So we're well above that. And any competent lender will approve this deal. So this is what a great deal looks like. Now, no deal is risk-free, right? There's no deal that you can buy currently that is risk-free. If there is, please contact me and list with us or let me know, and I'd love to buy it. But the best buyers don't avoid risk. They understand it and price it correctly. Owner dependency of this company is about a medium, right? Dave is the rainmaker. So our solution to this problem is a 12-month transition agreement where Dave stays as VP of sales at a salary of $80,000, earnout tied to 92% customer retention. Now his interests align with ours. And then interest rate exposure is low, right? We're using an SBA. So the SBA rate is a variable. So we've stress tested to 12%, and this deal still covers debt service. So when it comes to the labor market, we're at a medium, right? HVAC techs are hard to find everywhere. Our mitigation, above market pay, company vehicles, 8 EPA certified techs already on staff, kind of covers that. But just in case, make sure to hire FY or look over your team, facilitate any changes necessary. Now, when it comes to seasonality, very low. The maintenance contracts base moves swings, and as you know, people need HVAC in the winter, in the summer, and if you live in the US and you live in a hot state, you need it all the time. Now, deferred maintenance, right? Third-party inspection, pre-close, it's going to be $75,000 seller credit for anything found, and we're protected on that end. And then lastly, let's bring this all together. We walked through every layer of this deal: business profile, 3 years of financials, sorry, I'm losing my voice, the QOE, or quality of earnings adjustment, the valuation rationale, the full financing stack, the cash flow returns, the risk adjustment, every single category passed. So revenue growth passed, EBITDA margin passed, clean QOE, that passed, fair multiple, bankable financing, cash on cash return, manageable risk profile. So our verdict on this deal, we would highly recommend submitting an LOI at $6,010,000. Sorry, I don't know how I messed up those numbers, but here's what to take away. This is the level of analysis you need on every deal, not on the back of a napkin, trying to calculate numbers, but you need a full systematic walkthrough. So you need the income statement, QOE, valuation, capital stack, cash flow, risks. Bring this to a lender, and you're not just another buyer off the street. You're a professional, and you will get finance, and you will close deals. Thank you again for watching this video, and I'll see you on the next one. Take care.